Chop suey mukat. This is what we said equities were last time. We said it's home on the range. And I said the chop suey market is my least favorite Chinese dish. Well, that changed because we went from chop to decline. So let's remind everybody our equity themes for 2026. When we started the year, we thought that we would see the Mag 7, the tech stuff kind of lag because they were lagging since October. We thought the small caps would lag a little only because they had led up and they needed a breather. We thought the leaders would continue to be energy, utilities, basic materials. That is the case. And then there was a lot of conversation about emerging markets and commodities. In our last event, there was this conversation about, international is outperforming the U.S. And I had shared with everybody, I said, yeah, but I've seen that before. I usually don't fall for it because it's short-lived. Well, shit, man, timing on that statement couldn't have been better. And we talked about it. I said, well, if I was going to go international, I'd be looking at Japan or Germany. Hell no now. Guess what? The Brent crude goes higher in Germany than it does, in the U.S., right? They're more affected by Brent crude, and it gets more affected by Iranian oil than not. Then Japan, they're totally dependent upon outside energy. They have no energy, natural resources on their island. So both those markets after our last event have cratered down 10, 20% relative to only 5 in the US. So that was a good example of why I don't really sometimes buy into these narratives about emerging markets or international, because they might lead for a couple months, but then they end up just disappointing me, So our thesis mid-year, we thought we'd have some volatility. Well, the mid-year volatility is happening now. So, the first point above, you can say check. The second point is check early. I still think what we're experiencing now is a correction, not a bear market. 60-40 on that. It'll become 50-50 if we continue this excursion for too much longer. It starts to raise, recession worries. And then we said, midterm years tend to have year-end rallies. You just get past the midterms, and I still think that happens here. I think right now there's nothing to dispute the idea of a year-end rally. So I still would be a buy at this moment. I'm still a buyer of mid-year weakness in select sectors. And I still feel that way. Check with me next month and month after, because if this Iran stuff goes on too long, I could change my theory. So I gave you guys here a spring update. I said the risk of recession and bear market has increased since our last event. I think if you would ask me last event, I would have said it's 20-25% odds. Now we're at 35-40. If we don't have a resolution to this event by next event, you'll probably see me push those odds higher. So here's the S&P 500 that we shared with everybody last month. We gave everybody our levels. If this market was uber bullish, we wouldn't break below 67, 6,800. If it's really long-term bull, we want to stay above 6,500, and you kind of see that happening now. We broke below 67, 6,800 on the start of the war. We got down to about 64-ish. We're kind of playing around between 65 and 66. So you can kind of see this long-term bear level. We keep playing around. So right now, let me go back. Here's an updated chart. You can kind of see we're resting right on that 200-day moving average. So the market's done everything that it needed to have a pretty run-of-the-mill correction and is free to go back up if that's meant to happen. My inclination is it's not quite over. I feel like we haven't gotten the flush. Like I haven't seen the VIX spike high enough or enough fear really to happen. And the problem with me saying that is one thing that's happened for 2 months now, the VIX has been at, and the VIX is a volatility index, if you're not familiar with it. And it usually lives around bar mitzvah age, about 12, 13 is the level that it tends to stay at. It's been around between 24 and 25, 26, kind of that level. And the VIX normally doesn't live in the 20s. It's not a drinking age item. Like if it's usually around drinking age at 21, it's either going higher or lower from that level. And so we've been hovering around that drinking level age for a while, which tells me the only way to get to that level is money managers are buying puts because it's a ratio between puts and calls. So if they're buying more puts, it pushes that price up, that ratio price up. So when we're in the 20s, it tells me that money managers like me are pretty well hedged. So maybe you don't get a flush out because they're hedged against it. Like nobody's getting that hurt. So maybe my thought process of needing to see a flush out in this market before a solid bottom is wrong. But right now, I still just don't think the bottom's in yet. I'm not opposed to admitting it is. We and our Quiver clients, we created about 25% of our allocation in cash a day or two before the war started. What we left in the account, like I mentioned before, is some energy names, some basic material names. We have like 1% exposure to the Mag 7. So we're pretty hedged, and then we have our metals exposure. So we're like, what the decision I have to make is if this market has bottomed, I'm underinvested at this moment, and I'll have to chase to get back in. If the market has more downside, then we're sitting pretty because I've got a lot of things I can work with from there. And the reason I'm in that positioning is because another chart from Jason Haver is this is a very long-term chart of the S&P 500, and I've been showing it for months saying, hey, don't forget that this market is in unprecedented territories from a valuation standpoint. And since the 08 bottom, this market's done everything it needs to be from an Elliott wave standpoint. It's made all the wiggles and moves upward that it needs to, that if the intention of the market is to end this bull market now and we go into a 2-year bear market, that's available too. I mean, that we're not far from that moment either. And what could cause that? Well, maybe oil prices getting higher, So I hope that's not the case, but I've got to be aware of it as a money manager because my job is to protect money. So update on our barbell approach. It's still working well. Energy is bolded because it's still a position in the portfolio. We've kind of had to adjust because as the market is traded around, we've reduced our traded REITs. We've reduced our exposure to tech. We've reduced our exposure to materials and healthcare. We got rid of all financials. So we'll come back to those spaces when the market starts to come back up. We still have some crypto exposure because it's actually performed pretty well in this downcline. We've been adding recently to Raytheon and some aerospace spots. We still have some of our energy holdings, like I said before. We've brought in some natural resources and industrial names. And then in the middle of our barbell, we continue to hold the metals and some of the energy stuff. So still working. It's just now we have more cash to work with. So now we're just going to watch to see what happens because bottom line is that sideways correction has deepened. I don't know if it's over yet. It's easy to say no, easy to say yes, but give it a little more time. The levels that I'm watching is really, 6,300 level. If we stay above that, it's still a very bullish pattern. So I'm not too worried about claiming we're going into a bear market or recession until we get below 6,300. And then the early leaders coming out of this decline, right now, when I look at the charts, I like the looks of basic materials. I like the looks of industrials. I'd be looking to trim and take profits out of energy. We already trimmed it, took some profits out of utilities. They still look pretty good, but they're starting to look a little weak. And then in the tech sector, I would look at cybersecurity. It's in some of the software area that has been incredibly oversold. So there's a couple of cybersecurity names out there that I may be adding to the portfolio because I think that they've sold off enough that they're intriguing. And with AI, even with the war and everything, AI build out is still going to happen. And if you're building out AI, the budgets for cybersecurity are going to increase. So I still like that those areas. So those are the areas that I'm looking to come out. So Justin, I think Patrick left us, but what do you feel about equities? Do you have any concerns? Do you see anything you like? Are you hearing questions from your clients?
I guess I think you hit probably the question of what would be if it is a more than just a correction, and what could be on the horizon that would create that. If you think back, we're not in the 2008 thing, so it's not some type of housing crisis. Maybe a little bit of .com, but that's kind of gotten washed out with the Mag Sevens getting kind of hammered the last 6 months or so, and especially this year. So, what would be the thing that would take us from just kind of like we were saying, a standard correction that may throw us into a full-fledged, recession type situation? Obviously nobody wants to see a depression, but, maybe some type of recession. And, maybe that thing is going back to, the very beginning, is maybe it is that oil trade, maybe. Because if you think and you pull up Jason's chart again, really those big rollovers and real deep rollovers were from what? The .com, the 2008, COVID, and then the minor one of the tariff tantrum.
Yeah.
So I guess so I guess it just kind of goes back to, not necessarily a question, but I guess just kind of goes back to keep your eyes on maybe that oil conversation and the price per barrel. Because I mean, look, at the end of the day, the banks seem to be fine. We're not hearing anything under the surface of the banks are totally over leveraged, and we're going to get some major runs on the banks for this or that, or there's a housing crisis, or those kinds of things that could throw us into some type of wild recession type situation. So I mean, I guess it's not, like I said, not necessarily a question, just more of an observation.
Yeah, I think you're right. I mean, I think the biggest threat is inflation. It's I think that'll become the next big topic matter. If you think over the last year and a half, we've kind of gone from inflation to stagflation to and now we're going to be back into this. Do we hit a recession with inflation? Because that's what we've experienced when oil prices have done this before, and that's so. um, we'll see. How do we deal with it? I mean, as investors, we already know how to deal with it, but all the sectors and asset classes we talked about is what you lean into. It's just how do you deal with it psychologically, because it will be a psychological nightmare for a lot of people. All right, so let's